everyone. Today I'm going to present my research for the international conference. My name is Kayla Sabitha and I'm from Institut Bandung Teknologi (ITB) and I major in business management. So the title of my research is Economic Freedom and Capital Controls: Why Indonesia Trails Singapore in Attracting Foreign Direct Investment. For the abstract, this paper examines the factors influencing the disparity in foreign direct investment attraction between Indonesia and Singapore. Despite Indonesia's resource wealth, Singapore consistently receives a significantly higher volume of FDI. The research explores the connection between economic freedom, capital controls, and investors' confidence. It finds a correlation between lower economic freedom ranking and a higher capital control in Indonesia compared to Singapore. These factors, along with concerns about insider trading, are identified as potential deterrents for foreign investors. Let's move on to the introduction. Imagine two Southeast Asian countries, Indonesia, a land with natural resources and a vast population, and Singapore, a smaller nation with a reputation for financial strength. While both offer potential for foreign investors, Singapore consistently outshines Indonesia in attracting foreign direct investment. This sparks the question: why does Indonesia struggle to attract foreign capital? Foreign direct investment is important in the capital market for economic growth and development. The FDI provides access to financial, technological, knowledge, and global markets. Therefore, Indonesia, with a large population and abundant natural resources, is a potential capital market. However, it stays behind Singapore in terms of attracting investment. Singapore leads as it establishes itself a financial base that is no less competitive than Indonesia, leading to a persistent inflow of direct investment. This is because attracting foreign investment requires a stable environment that is based on trust and predictability, which Indonesia lacks. This research delves deeper into the reason behind this disparity. I will explore the relationship between economic freedom, capital controls, and foreign direct investment. By examining the contrasting cases of Indonesia and Singapore, I aim to shed light on the factor hindering Indonesia's ability to attract foreign capital. Unveiling these factors could pave the way for policy changes that unlocks Indonesia's true economic potential. Next, onto the problems. The first problem is limited economic freedom. This includes weak property rights, lack of government transparency, and excessive regulation which discourage foreign investors from entering the Indonesian market compared to Singapore. Then, the second problem is capital control. These are government regulation that restrict the movement of money in and out of a country. While they can be used for various purposes, they can also make it more difficult for foreign investors to invest in a country and return their profits. Moving on to the literature review. For this literature review, we have three main factors, which is FDI, economic freedom, and capital controls. So according to the UNCTAD, FDI is defined as an investment by a foreign company into a business in another country with the intention of acquiring a controlling interest, and they play a vital role in economic growth. Studies by the Hong Kong Trade Development Council, written by Edwin L., highlights Indonesia's struggle to attract FDI compared to its neighbor Singapore. This gap might be linked to factors like regulations and transparency. Singapore's reputation for strong property rights and controlled government spending can be attractive to investors who prioritize these factors. By addressing these concerns and creating a more investor-friendly environment, Indonesia could unlock significant economic benefits through increased FDI. Next is the economic freedom. The concept of economic freedom, often measured by rankings like the Fraser Institute, influences investment decisions. This index takes into account variables such as property rights, government spending, and business freedom. From looking at the Economic Freedom of the World Annual Report 2023 from Fraser Institute, Indonesia ranks 74th out of 71 Southeast Asian countries. Indonesia scored poorly, unlike Singapore, Malaysia, Brunei, or the Philippines. Indonesia lags behind Singapore because of its weak policy and investment trade supported by massive corruption. Economic freedom leads to equitable. Finally, I looked at the capital controls. Sometimes, these regulations can lead to information asymmetries in which some people have access to critical knowledge about upcoming policy changes or currency fluctuations while others do not. In the case of these conditions, some people who have such secrets can capitalize on the weaknesses of these markets to perform self-centered insider trading. Next, we have the hypotheses development. The independent variable is economic freedom of the world and capital controls, while the dependent variable is foreign direct investment. Here, the main research question will be number 1, is there a relationship between economic freedom and foreign direct investment? And number 2, is there a relationship between capital controls and foreign direct investment? Next, I will talk about the methods that I will use for my research. To fully comprehend the research subject, I will use a mixed method strategy, integrating quantitative and qualitative techniques. There are 3 factors of this method. It's data collection, data analysis, and triangulation. For data collection, data on FDI inflows, economic freedom, and capital controls will be collected from established resources such as World Bank, the Fraser Institute, and the International Monetary Funds. Next is the data analysis. For FDI inflows, I will be comparing historical and current data. For economic freedom ranking, I will analyze position from the Fraser Institute. And for capital controls, I will use the annual report on exchange arrangement and exchange restriction database to explore restrictions. And for triangulation, by looking across data sets, this helps uncover connections between variables. For instance, a lower FDI in Indonesia might be linked to periods of high amount of capital controls or a poor economic freedom ranking. Let's look at the results and findings. Looking at the World Investment Report 2023 from the United Nations Conference of Trade and Development, we can see that Indonesia has ranked 20th compared to Singapore, who is ranked 4th based on the FDI inflows of 2021 and 2022. Recently, Singapore, who has the largest recipient, registered another record that indicates an increase of 8% from 131 billion in 2021 to 141 billion in 2022, which accounts for almost 2/3 of flows to Asian countries. Indonesia had also experienced an increase of 4% from 21 billion in 2021 to 22 billion in 2022. However, if we look at the whole 5 years, the highest FDI inflows was in 2019 with 23 billion, and Indonesia has yet to compete with that number in the recent year of 2023. While it is a good thing Indonesia has increased FDI inflow, the gap between two countries is still wide, with the missing opportunity of 119 billion for Indonesia, as they are struggling to attract an abundance of FDI inflows. Therefore, we need to look further as to why the gap between these regional countries is wide. Next, we will look at the economic freedom rating from Fraser Institute. Countries with a lower economic freedom like Indonesia compared to its Southeast Asian neighbors tend to attract fewer foreign direct investment. This is because the lower economic freedom connects with a lack of transparency, which makes it difficult for foreign investors to assess risk and opportunities accurately. When economic freedom is low, foreign investors may face uncertainties due to unpredictable regulation or unclear legal frameworks. This discourages them from investing compared to countries with a more established and transparent system. In essence, economic freedom fosters an environment of transparency, reduced corruption risk, and a predictable legal framework, which is all essential ingredients for attracting FDI and boosting economic growth. Finally, we will look at the annual report on exchange arrangement and exchange restriction. As you can see from the tables, it is clear that Indonesia has more capital control than Singapore. This is significant on the section on capital controls, where Indonesia has imposed capital controls on 9 out of 11 controls, such as on capital market securities, money market securities, and collective investment securities. Meanwhile, Singapore has only implemented control on the financial credits and control on real estate transaction, which is only 2 out of 11 controls. According to the IMF, capital controls can hinder transparency in the nation's financial markets. This lack of transparency makes it difficult for investors to assess risk and opportunities. Restriction on foreign exchange reportings can obscure capital flows, while lack of government openness about economic policies can make it hard to predict future changes. Limited investment flexibility, such as restriction on return on profits, further discourage foreign investment. While capital controls may be used for temporary crisis management, policymakers must balance their goals while maintaining openness for market efficiency. Finally, I will discuss the conclusion and some recommendations for this theme. For conclusion, this study compares FDI inflows in Indonesia and Singapore, highlighting Indonesia's struggle despite its resource wealth. The research suggests economic freedom as measured by the Heritage Foundation and Fraser Institute plays a key role in attracting investment as well as the capital controls from IMF. Indonesia's lower economic freedom scores compared to Singapore could be a significant factor hindering FDI inflows. For recommendations, to attract more foreign investment, Indonesia should focus on streamlining regulation, safeguarding property rights, and promoting ethical behavior through investors' education. Collaboration with regional partners and financial institutions can also strengthen regulatory frameworks and transparency, while empowering investors through education programs will equip them to make more informed decisions. Thank you for listening. I hope my research will benefit Indonesia and many more.